All right, let's get right to it. We're here to talk about a critical emerging risk to the US dollar, specifically how a completely unprecedented challenge to the Federal Reserve's independence is creating a new and very real threat. Consider this your executive briefing on a scenario you absolutely need to understand.
Okay, so here's how we're going to break this down. First, we'll define the core threat. Then, we'll look at the specific two-pronged attack being used to pressure the Fed. After that, we'll see how markets are reacting, what the long-term systemic risks look like, and finally, the key things you need to watch for next.
So let's just cut to the chase. The bottom line is this. We're witnessing a sustained political pressure campaign against the Federal Reserve. And look, this isn't just the usual background noise from Washington. It is actively creating a tangible, measurable, political risk premium on U.S. assets. And this quote, it really says it all. This is from a hypothetical statement by Fed Chair Jerome Powell set in a near future. He's essentially laying it bare, arguing that these legal threats aren't about justice. They're about forcing the Fed to bend to political will on interest rates. It really doesn't get much more high stakes than that. So how is this pressure actually being applied? Well, it's not subtle. We're looking at a pretty audacious, two-pronged legal assault aimed right at the Fed's leadership. The goal seems to be to challenge its autonomy from every possible angle. And here's the playbook. It's a classic pincer movement. On one side, you have a criminal investigation into Chair Powell himself, focused on, of all things, building renovations. And on the other side, you have a direct legal challenge to remove Governor Lisa Cook. This second part is absolutely key because it attacks the for-cause protection, that legal firewall that's supposed to stop Fed governors from being fired for political reasons.
And just look at how fast this timeline escalates. It goes from some initial scrutiny over construction costs in the summer to a direct attempt to fire a governor, and then boom, grand jury subpoenas for the Fed chair. The speed here is a weapon in itself. It's designed to create chaos and pressure.
So the big question, how are the markets taking all this? Well, the reaction was swift, and it tells you everything you need to know about how seriously investors are taking this threat. They are absolutely pricing in this new uncertainty. Just look at this number. In the immediate fallout, gold, the ultimate safe haven asset, absolutely took off. We saw prices testing $5,300 an ounce. That's not a rally, that's a scramble for a hedge against potential currency debasement. This table just lays out the shockwave perfectly. It was a classic flight to safety. The US dollar, a broad sell-off. Equities took a hit. Even US Treasuries saw a brief sell America trade. And where did that money go? Straight into hard assets like gold and silver, which, as we saw, just surged. And this quote from Carl Shimada at Corpay, it just nails the market sentiment. This isn't being viewed as a normal policy debate. It's seen as someone just tossing a massive, unpredictable variable, political revenge, right into the core of U.S. monetary policy. And there's a name for what we're seeing. Analysts are calling it a debasement trade. Plain and simple, it's a bet that a Fed under political control won't be able to protect the long-term value of the dollar. So investors are forced to run for cover in things that can't be printed.
Okay, but that initial market shock, that's just the opening act. The real danger here, the thing that should be on every risk manager's radar, is the potential for permanent, systemic damage to the entire U.S. financial system. Strategists are now tracking 4 huge systemic risks. First, inflation expectations could become unanchored. If people lose faith in the Fed, it's game over. Second, the dollar starts to lose its status as the world's ultimate safe haven. Third, we could see a permanent political risk premium slapped onto U.S. debt. And what does that lead to? Well, that's the fourth point, higher borrowing costs for everyone in the U.S. economy.
And this is the core of it, right here. The whole global financial system is built on one simple idea, that U.S. Treasury debt is risk-free. But if the market starts to believe the Fed's independence is gone, that assumption gets shattered. The bedrock of finance could start to carry a political premium, and that would reprice literally every other asset on Earth. All right, so looking forward, what are the tripwires? What are the key signposts that are going to tell us which way this crisis is headed? There are 3 near-term events to watch like a hawk. First, the Supreme Court's ruling on the Lisa Cook case. That's going to set the rules of the road for firing governors. Second, the Senate confirmation hearings for the next Fed chair nominee. You can bet that's going to be a proxy war over the Fed's soul. And third, what happens when Powell's term as chair ends in May? Legally, he can stay on as a governor, which would create a really tense and totally unprecedented dynamic on the board. So, this all brings us to the final critical question for anyone running a book or managing risk. For decades, the entire world has taken for granted that U.S. assets have an independence premium baked in. Right now, that premium is being repriced in real time. The question you have to be asking is, what is our plan for the day it disappears entirely?